Well, good afternoon and welcome to our April Ranching 101 webinar presented by AgTrust. Questions about accounting and finances regarding tax season and beyond are answered in this solution-based webinar. Before we start, please join me for a short message from AgTrust.
When your passion is agriculture and a rural way of life, you need a partner who understands. That partner is Ag Trust Farm Credit, formed from two trusted farm credit associations. Our mission is to provide personalized financing tailored for full and part-time farmers, ranchers, agribusinesses, and rural homeowners. And because we live in the communities we serve, Ag Trust Farm Credit is here to help you succeed.
I want to remind everyone to join us on May 21st for our next Ranching 101, where we will hear from Tejas Ranch and Game Fence. Sponsoring today's Ranching 101 webinar is CLA, and we are excited to have Brant Self join us today. Brant leads CLA's agribusiness industry group for Texas and the surrounding states and dedicates most of his time to serving farmers, ranchers, and processors. He identifies opportunities and creative solutions for his clients through tax research, planning, and compliance for privately owned businesses and their owners. Realizing that each client is unique, Brant has built deep relationships and trust with his clients by getting to know them and helping them with their needs. Growing up in a small town in North Texas, he understands the industry's issues and strives to help his clients improve their operations. If you have any questions during the webinar, please submit them in the chat box. And at this time, I'd like to turn it over to Brant.
Perfect. Thank you. And thank you everyone for joining today. Excited to be here and just kind of talk through this with you guys. Can you see my screen okay?
Yes, we
All
can.
right, perfect. All right, so we'll get rolling here, but I would like for this to be as interactive as possible. I know with it being a webcast that is limited a little bit, but if you have any questions or anything, please put those in the chat. We will get through those as best we can at the end of the presentation, but if there's something pressing, we'll try to dive into that right away. So just get moving here. If I can get my screen to advance. Oh. So this is just we'll make this presentation available after the fact, but this is just basically saying I am a CPA, but I'm not necessarily your CPA. So that's all this is. Just a little bit more about me. This is myself and my younger sister way back in the day. Feels like an eternity ago at this point. And this is kind of my current situation. I've got a beautiful wife, two beautiful daughters, and a little boy that definitely keeps us on our toes. So excited to join my background with kind of loving growing up around horses and everything else with my family and kind of bridging that with my current profession, which is accounting. So a little bit about CLA. We have nearly 130 locations across the country. We serve 14 industries, but the only industry you probably care about right now is our agricultural industry. So I lead our ag group for the state of Texas and the surrounding states. We work with just a ton of producers, processors, co-ops, all kinds of things. But the unique thing about CLA is, although we have the resource of a national firm, we only focus on small and privately owned farmers and ranchers. So we don't do any publicly traded stuff. So move through here and get into the actual presentation. So if you guys were at the TSERA convention back a year ago, a lot of these slides were in that. We're going to kind of run through those as well. I had some pretty good feedback at the convention this year with the presentation. So since this is the Ranching 101, I just thought it'd be a good idea just to kind of go through this as well. And so if we start talking about what drives the cow-calf industry, it's a number of things. It's the American cowboy image. It's the fact that a lot of people just love cows. There's obviously land. There's no more land being made, so it's a real estate appreciation. The operating losses that can come from that, re-leveraging that higher market value of land to fund operating losses is big. And a lot of times it's using other forms of wealth and income to fund operating losses. So, you might have someone who's been an executive in a prior life, made a lot of money in whatever their chosen profession was, and is now ready to get back to their roots and maybe buy a ranch or a farm and want to become active in that. But that's where kind of some of the other challenges come in with hobby losses and everything else that we'll cover here in a bit. So what are we up against? Obviously, higher feed costs, fuel costs, building costs, labor costs. Everything is high. Drought conditions continue to be an issue. And then I just think this statistic is always interesting to me. Operations with fewer than 100 beef cows account for 90.4% of all the beef operations. And so, when we think about that, that is you guys. That's everyone on this call today. And so, why are we here, and what are we talking about? Well, so if you're to think about your own farm or ranch, profitability is a big sticking point, especially if you are not if you're not a hobby, if you're not doing this just because you love it, but you're doing it for with a profit motive. How do you gauge profitability, and how do you allocate your time and energy, and how does that align with kind of the profitability of your company? So even in good years, some producers are losing money, and even in bad years, some producers are making money. And so it just kind of depends. A lot of these are the decisions that you make as business owners of how you're running your operation, right? And studies suggest that costs are more important in explaining differences in profitability between operations than production, price, weaning percentage, and all these sorts of things. And so all of you on this call probably know all the ins and outs of those very well. But with what I do every day and talking to new clients, a lot of times throughout the year, a lot of the times, many of our clients, they don't ever really have a good understanding or a good idea of what their profitability is. And so 3 questions for you as a business owner. Do you know what it costs you to raise a calf? Are you minimizing your current tax liability? And we'll talk a lot about tax planning. And guys, tax planning isn't when you send your documents to your CPA to prepare your tax return. That's no longer planning. That is simply compliance at that point. So planning happens before, right? So if we're talking planning, now is the time to do tax planning for 2024, not after we close the year on 2024. And then finally, we'll spend a few minutes talking about, are you planning for the future of your business, and things like with succession planning, a gift and estate, all that sort of stuff. And with all those rules about to change and sunset here in the coming years, it's really important just to kind of dust that off. And so we're going to spend a few minutes now talking about kind of accounting systems, the differences in accrual basis accounting and cash basis accounting, and what that means. And this is the crux of the matter here when we start talking about, are you making money, but also does the amount of money that you're making translate into cash flow for you, and how do we gauge how your businesses are doing? So what is it? So what's a cost accounting system? Well, first let's talk about what it's not. As we've said before, it's not a check register. It's not a shoebox of invoices and receipts. And again, it's not your Schedule F on your tax return. That is simply the result of what you've done from an active management perspective for that prior year. A lot of people struggle with the difference in what you might show as taxable income versus what is in your check register, or what's in your check register is not always what is showing up on your financial statements either. What it is, it's a way to track all of the buckets, if you will, to understand the costs that it takes for you to run your operation. So those are the essential costs that it takes. Those are the tax motivated costs, and those are the nice but not necessary costs as well. And so, oh, there we go. So a cost accounting system allows you to access the information you need to understand a number of things. The first is cost of raising a calf, right? Um, if a calf is what you're selling, if that's the way that you're making money, you need to understand your cost. Any business that is selling any sort of product or service has to know the cost of that product or service and know if they're making money. So then if you know the cost of raising that calf, what does your sales price have to be to break even? And then what changes can you make to move from being in a loss position to being profitable? And I've heard this saying many times before, what gets measured can be monitored and improved. So if you're not tracking anything, if you're just basically dumping everything in a shoebox and taking it to your CPA at the end of the year to prepare a tax return, you can't really make any on the fly improvements, because you don't know how you're doing until the end of every year. And then that's only again, it's a data point looking at prior year activity. Commodity markets always pay the average cost of production over a 10-year period. So if you're less efficient than average, you will lose money over a 10-year period. But if you're more efficient than average, you will likely make money over that 10-year period. And the ability to differentiate yourself from the other competitors in the market is what's going to help you be more successful. And so now let's break it down. Let's start talking about the basics of accounting, right? So the basic financial statements that you all should be looking at if you're running this as a business is a balance sheet, an income statement, and a cash flow statement. And you'll notice in next to a balance sheet and an income statement, I have accrual basis. And so a lot of times me as a CPA, and especially I'm a tax guy, so my genesis of what I do is helping clients minimize their tax liability, right? And so, as you all know, yesterday was a tax deadline, so it's been a really busy last several weeks for me, and so been doing nothing but churning out tax returns. And so, I want to know what taxable income is because that's what we're going to pay tax on. But you, as business owners, need to be able to separate the two, and there it should be a difference in what your financial statements on your books show versus what your tax return shows, because your tax return it's kind of fantasy land, if you will. And there's a lot of provisions from a tax perspective that allow you to accelerate deductions to minimize your tax liability. But when you start talking about your financial statements, your balance sheet, that can look quite different, right? And a simple example of that is fixed assets or depreciable assets. You might buy a tractor and the tax law says that we're going to depreciate that tractor over 7 years. And we might write off 100% of that tractor in year one, but you as a business owner know generally how long you expect to use that tractor. So if that tractor is a 10-year asset for you, you think you're not going to buy another tractor for 10 years, put it on your books as 10 years, depreciate it over 10 years. So you're aligning the true accuracy of what those depreciation dollars are with kind of the reality of when they're being used. So assets, that's what you own or are owed. Liabilities, that's what you owe to other people. And the equity, that's the life to date net income or loss of the operation. The income statement, the revenue expenses, this is pretty simple to understand. The revenue is the income that you earned, and the expenses are the expenses that you paid or incurred. And incurred is important because depreciation, right? You buy the tractor, you might finance it. Cash outlay can look a lot different than the depreciation from both the book and a tax perspective. So understanding the inner workings of accrual basis financial statements and also tax basis financial statements can really help you kind of know how you're doing as a business owner. Additional management reports, cost of raising a calf, keep tracking this information the best you can, right? And if you don't know how to do this or don't have a starting point, start somewhere, right? All it takes is putting a spreadsheet together, or just grab you a piece of notebook paper and just start trying to document what you're spending on your operation. What does it cost you to raise that calf? An inventory listing report. This is highly important. This is cattle you own that are held for resale. Like if your operation model is you're going to go buy cattle and then you're going to sell those, those cattle on your balance sheet are just inventory items. Or if you're in a breeding operation, you need to know what your total cost basis is in those breeding animals. And you also have animals on your financial statements that may not, or animals living on your land that aren't on your financial statements. Like if you have calves that you're raised, right? Those costs may not be reflected on your balance sheet if you haven't been capitalizing those. Fixed asset listing. Again, make sure that you're keeping track of all your fixed assets, tractors, trailers, sheds, barns, fences, all that sort of stuff is important for you to be tracking and keeping on your financial statements. Accounting methods. So we talked briefly about this already, but cash basis accounting or tax basis accounting is different from accrual method of accounting. Cash basis accounting is pretty much what it sounds like. If you spend $1 cash, that's when you get the $1 deduction, right? It's pretty simple. If you sell something, you don't record it in income until you get that dollar of income. So if I sell something to my friend, that if he doesn't pay me for 3 years, well, why am I going to pay tax on that income? Because I have never received that dollar of cash, right? But if he pays me immediately, then that's going to go on my income statement. So understanding cash basis of accounting is usually pretty simple for people to understand, because that goes back to kind of your checkbook accounting, right? You know the amount of cash in your checkbook, and so that's what you would expect from a lot of people. Think that's what their taxable income should be. Accrual method of accounting is the exact opposite. So you're recognizing income and expenses when they are incurred. It gives a better indication of business performance, because like I said before, if you are just keeping your balance sheet on a tax basis, on a cash basis, you do not have a true accurate picture of the business performance and an accurate balance sheet to know kind of how you're operating. So the biggest difference in the cost of owning a cow doesn't fit neatly into a calendar year, as many of you know. So you have to use accrual accounting if you truly want to know what your cost to raise a cow and wean that calf would be. Some other considerations to consider: management financial statement should reflect book. Again, this is where having a CPA can really be helpful for you guys that understands your business, your industry, but also why you should have a book set of financial statements, an accrual set of financial statements, because that is how you are going to be able to run your business from the most accurate picture of your business performance. Management financial statements should reflect nice but not necessarily items below net operating income. And what do I mean by this? So some of your competitors might be driving around in a brand new pickup. They might have all the best equipment, but that's not necessary, right? You could probably get by with a 5-year-old truck, right? Not the latest and greatest of everything, because basically, your cows should be paying for your lifestyle. And if your cows are paying for that brand new pickup truck every year, if that's what's going on to your financial statements as depreciation on a new vehicle every year, it's going to look like you're losing money every year, which you are from a tax perspective, right? But again, not from a business perspective, because that asset was maybe not necessary. It's nice, but again, it's not necessary. So again, understanding that your financial statements are for your benefit as the business owner, and your financial statements are going to look different than your neighbor's financial statements, right? What's important for them to track and monitor and manage might be different from your operation, right? If you just so understanding that your book financial statements are not necessarily what's going to be reported on your tax return. Any CPA that knows what they're doing is going to be able to take your book basis financial statements and convert those to a tax basis for purpose of the tax return. Management financial statements should track different revenue expense streams, so different enterprises. So this is another thing that I see often. So I've got a client that they have their farming operation, but they also have kind of a side hustle, if you will, where they make substantial amount of money making products, right? Well, it's important to understand how they're doing in both those areas, because does it make sense to keep making these products? Are we making money on those? But also, are we making money in the farming operation? What does that look like? And so breaking those two revenue streams out on your financial statements can be vitally important. And there's lots of ways that you can do that through QuickBooks and a lot of different accounting systems to basically have different enterprises, right? And for the quick example here, does buying the hay and selling equipment make more financial sense? So if you're going and buying a tractor and all the equipment necessary to grow your own hay, is that cost beneficial to you as a business owner? Or would it be better if you just sold all that equipment and pay someone to come in and bale your hay, right? So just thinking about these things, and putting maybe what you want. You might want that tractor and want all the equipment to bale your own hay, but if it's not making financial sense for your business operation at the time, does it make sense to do something different? The other thing is, what are your hidden costs? What do you have? Inefficient equipment? Do you have a piece of equipment that you spend more time fixing than you do using it for what its desired use is? Maybe you have some inefficient equipment because your time is valuable, right? Do you have inadequate feed quality, right? Are your cattle converting the feed the way that they should be? And again, your time. Don't underestimate the value of your time. There's only 24 hours in a day, and trust me, with the last few weeks with my chosen profession, I've wished there was more time in that 24-hour period, but there's just not, right? So your time is valuable. So what's the goal? And then we'll move on to kind of some overview of kind of specifics around farm taxation. So the goal of this is to create a cost accounting system that tells you what it costs you to raise a wean calf and compare that to national averages. Or if your operation is different from a cow calf operation, maybe you're a seed stock or any different number of business models, but whatever your desired revenue stream is, is your financial statements, is the way that you're doing your accounting giving you the information that you need to make good business decisions? Are you utilizing benchmarking by identifying strengths and weaknesses in your operations relative to others, right? There's a lot of data out there. You have a lot of people in TSCRA that care about you and your operation, right? That's one thing that I love about the ag community is there's a lot of shared successes, right? There's a lot of shared ideas and there's a lot of shared resources. And so use things like TSCRA, use things like your neighbor, use things like others in your community to figure out what's working for them and what's not working for them, because you might be able to there's a lot of value in those shared experiences. So but also understanding there's tremendous variability across producers, so don't use the take the advice that your neighbor gives you, but understand there could be a lot of variability across two operations that are maybe next door to each other. Again, there's a lot of factors in this. There's different family dynamics, there's different costs, there's different things that you guys might have to cover that your neighbor doesn't. So this means there's room for you to improve your situation and profitability. But again, it takes looking at taking a stance and looking at your operation as your operation and using benchmarking and other things to look and see where you're being efficient and where you're not, but also just understanding that there is probably room for you to increase your profitability. And find a trusted advisor, use associations like TSCRA and others, use CPA, use an attorney, use someone that in the feed industry, use all these different resources at your fingertips to maximize your business and your profitability. So we're going to switch gears just a little bit. Some of this was covered in what I did 2 years, I guess year before last at TSCRA, but some of this is just good general knowledge of farm taxation. And when I was trying to put my thinking hat on, when I get a new client, what are some things that they always want to talk about? Some of the first things that they want to talk about, and how do we address those? And so we're going to kind of march through this, but one of the first things I get, especially with people that are newer to farming or ranching, is everyone is worried about hobby losses, right? Because somebody somewhere has probably warned them, hey, hobby losses, hobby losses, hobby losses. Like you got to make money 3 out of 5 years, and all these different things. And while this is true, and understanding the hobby losses are out there, it should not scare you guys into running your business and to trying to make money in the farming and ranching industry. And it's also should not scare you from showing losses in the farming and ranching industry. So um, the tax definition of a farmer or rancher, it's based on the raising or growing of an agricultural or horticultural product. So it is not sufficient to merely sell or process an agricultural product. There's a necessity that you are actively involved in that process as well. And so some common areas that where we see this is if you have, someone that lives in the city, they've got a job in town, and have a farm or ranch, but really what they have is some land that they bought for their family to go out on the weekends and to hang out and have some fun on, right? Um, that is the prototypical picture of what these hobby losses were built for, to prevent you buying a piece of property, dumping a bunch of money in it to shield off farm income, right? And so, and the other big area that we see this frequently in is the horse breeding and showing arena, right? This is a frequently raised topic in those areas. But I'll say in both those cases, whether you do have a job in town and have a farming or ranching operation, that doesn't mean that it's necessarily a hobby. There is just some safe harbor losses built around the hobby loss rules that we want to talk about, right? And so, um, some questions that to ask. And so, anytime we run into these hobby loss issues with an IRS agent, these are kind of some questions that they're going to ask. And so, these are some questions for you to ask yourself on the front end. Because if it's a hobby, that's great, right? Just because it's a hobby doesn't necessarily mean that you're going to stop doing what you're doing, right? But if there's a profit motive, if you're expecting to take losses on your tax return, um, on Schedule F. If it's a business, we need to treat it like a business. So see, these are just some good questions to ask yourself. Is there a legitimate profit or gain motive, right? That's where it starts. Is there a profit motive? If there is, it's not a hobby, right? You're trying to make money in it. Do you have complete and accurate books and records? This is another big one, right? If you have a set of financial statements that you're taking the time and energy to track the profitability of your business. That sounds like a business, right? I've got some hobbies. I like to smoke meat. I love coffee and trying different coffees and things like that. I love woodworking, but none of those I don't have a profit motive in any of those, right? I grew up rodeo and I grew up calf roping. I would still love to do it sometimes, but with 3 kids, that hardly ever happens. But it's a hobby for me. Yes, I might go to a roping and try to make money, but I'm not trying to make a living at it, right? This is my job as a CPA, right? So, do you have a profit motive? Do you have prior expertise in the business? Again, not to say if you don't have prior expertise that it's not a hobby, but just these are some important factors. Seek advice from qualified. Did you seek advice from qualified advisors? Do you devote substantial time to the activity? Again, if you live here in Fort Worth and you have land out in far west Texas and you never go out there, you just have some cows out there that the neighbor takes care of. Do you spend enough time in that activity to truly try to make it profitable? Do you employ others to carry on the activity? Do you have the reasonable expectation of asset appreciation? Are you trying, again, goes back to the profit motive. Um, Taxpayer previously turned an unsuccessful business into a profitable one. All these are just questions that kind of get to the crux of the matter, whether there's a hobby or not here, right? And so there's a few more that you guys can all read too. We'll get the slides to you, I'm sure, after this presentation. There is a safe harbor provision. You must show a profit 3 out of the 5 years. Again, this is a safe harbor provision. So all that this means is that if you if you turn a profit 3 out of 5 years, the IRS will say that it's not a hobby, and you can keep filing that Schedule F, potentially taking losses. But if you have 2 years that have just astronomical losses, and then 3 years where you turn maybe a $500 profit, does that meet the intent behind the safe harbor loss provisions for hobby losses? And the IRS would probably argue no. But again, what do you do? Just because you have a loss 5 out of 5 years doesn't necessarily mean that you don't have a profit motive. That doesn't necessarily mean that you don't have a hobby, right? There's nothing in here that talks about like losing money, right? If you develop and memorialize a written business plan, that's a good way to limit yourself from hobby loss exposure, right? If you're developing and memorializing this business plan, here's what I'm doing, how I'm trying to make money. Here's what the time horizon of building up my herd, of building all my cross fencing, of doing all these different things. Because anybody knows that if you're starting a new business, it's capital intensive on the front end, no matter what you're doing. There's probably going to be some loss in those initial years, and it's going to take you some time to start turning that profit. But if you develop and memorialize a written business plan, and you're able to hand that to the IRS agent, if you ever come up against this, that's going to be a great step in the right direction for you to prove that don't have a hobby. If it's a business, treat it like a business, right? Separate the checking account and the credit card. Have a business checking account. Have a business credit card. Nothing is gonna make it seem more like a hobby than if you just have a personal bank account and you're making farm purchases through your personal bank account or your personal credit card, right? You might even be tracking those some way in an Excel spreadsheet or something. But if the IRS is going to say, if this was a business, why don't you have a business checking account, right? Do you have a set of financial statements? Again, if you do shoebox accounting, if you do checkbook accounting, it's just an easy way for the IRS to make the argument that you have a hobby. So the more ways that you are treating this like a business, you are acting like a business, you have all these different things in place, the more likely you are to be able to defend yourself that you don't have a hobby, right? Hopefully this makes sense. But again, I just wanted to address hobby losses because it seems like every new client that I get is worried about them, especially if they're new to farming or ranching. But again, it's something to know that the safe harbor provisions are out there, but that's not to say if you don't turn a profit in 3 out of those 5 years that that you're automatically going to be deemed a hobby. But there's just no safe harbor for you. So you need to be doing everything you can to treat it like a business. All right, some just few slides on documentation. So one of the primary reasons that tax deductions are denied to taxpayers is lack of appropriate documentation. So every expenditure for the farm or ranch should have an invoice or receipt. This applies to both checks and credit card purchases. So if you spend $1 for anything on your farm or ranch, you should be documenting it. and this is again, treat this no different than any other business, right? Any other business is going to be keeping track of all these expenditures because no business is in the business of losing money, right? You're not, you shouldn't be either. And so if you're doing this for a profit motive, you would be keeping track of all these things. Handwritten notes don't constitute a substitute for an adequate documentation, or in your head what you spent that $2,000 on. But if it's not documented anywhere, the IRS is going to say they're just going to quickly just disallow it and move on. Proper support should include the date of the transaction, the parties that were involved, the product or services that was exchanged, the quantity, total amount. Again, all these are pretty simple things, but you'd be surprised how many times we run into these sorts of things where there's no documentation out there. And again, it's not a problem until it is a problem, right? As long as you don't get pulled for audit or examination, maybe you never have an issue with this. But as soon as you do, you've got a problem on your hands trying to figure out how you're going to support these deductions that you've taken on your tax return. Carefully document and record non-cash or in-kind expenses. This is another common question we have. Well, I paid my neighbor $500 cash for whatever. He came over and he baled the hay or did whatever, and I just handed him $500 of cash. Ask your neighbor to provide some sort of receipt to give to you of what you paid for, right? Again, it's pretty simple, and most everyone that understands this, that they understand the reasons behind this. But again, there's a technically right answer and there's a practical answer for everything, right? Some of these you may not be able to get a receipt for, but do the best that you can, document in some sort of way. But if you are using it for like bartering, if you're exchanging, doing work in exchange for loans or labor for goods, or the use of ranch assets for services or goods, or anything like that, anything that's not like you wrote a check for it or there's a credit card transaction for it, you just need to do something to carefully document that information so that it's not disallowed. Mileage logs, everyone's favorite topic, and every client I have hates mileage logs, and I get it. It's a lot to keep up with, it's a lot to track, but they also want that mileage deduction on their Schedule F, on their 1040 tax return every year, right? And I tell clients all the time, I am not an auditor. I am not the IRS. I am not going to ask you to send me your detailed logbook day by day. But what I am going to ask you is, do you have a record of the mileage that you've driven? Do you have a logbook? Do you use an app? Do you take pictures of your odometer, beginning of your trip and ending of your trip, whatever? I don't care what you're doing as long as you're doing something. But just because it's a pain in the butt to do, that's not an excuse for not doing it, if that makes sense. Just do something. Sorry, I saw some questions in here, a couple long ones. I'll answer Robert's, and then we'll circle back to Melinda's questions here at the end. But Robert, you said, do you feel like canceled checks, credit card statements, and feed store statements work in place of actual receipts? Yeah, absolutely. Basically, as long as you have something documenting that purchase, I think those are all good alternatives. Again, so if you can, when you go to the feed store to buy feed, if you can just throw that receipt in your glove box or in a folder in your truck or whatever, if you can keep and maintain those, that's going to be the tried and true method of defending that with the IRS. But if you have something like a canceled check or a statement that you can get from the feed store for at the end of the year of all the purchases you made, all those I think are still going to be helpful in showing those as proving those out of the IRS, if you will. All right, so we can talk about accounting for livestock. This is another area that I think is done incorrectly a lot of times on clients' financial statements. The inventory or fixed assets from a livestock perspective is really important. So again, this goes back to your business model. Like, what are you doing? How are you trying to earn money? If you're just going and buying cattle and selling them after they gain weight or at better prices or whatever, those cattle to you are inventory. So you buy that animal, you capitalize it, you put it on your balance sheet, and you do not get a deduction for that animal until you offset the gain, the proceeds that you get from selling that animal. So that's reported on your Schedule F as ordinary income, and it is subject to self-employment taxes. Well, what about fixed assets? What about livestock held for breeding purposes? These are costs that are available to be depreciated, right? They are going to be capitalized to your balance sheet the same as the inventory would, but the difference is that we can take depreciation on these. So the gain from livestock held longer than 24 months is capital in nature, and so that's quite different than the inventory, right? Inventory we just talked about is self-employment, subject to self-employment tax, but it's also subject to ordinary income tax rates, where the sale of breeding stock is going to be capital in nature. Of course, you have ordinary income on the depreciation recapture. So if you buy a cow for $1,000 and you fully depreciate that animal, and so now your tax basis is zero. 5 years down the road, you sell that same animal for $500. You're going to pay ordinary tax on the $500 because you got an ordinary deduction in prior years. So you're going to have to recoup that depreciation through ordinary income recapture. Losses from livestock held longer than 24 months are ordinary losses too, though. So that's the good part of that too. Is so basically, if it's a fixed asset, if it's a breeding animal, you get a lot better from a tax perspective, a lot better answer than inventory. But if it's inventory, it's inventory. There's no other way to you can't make it capital asset or fixed asset. Depreciation. So I'm sure everyone is aware of this, but bonus depreciation used to be you could take 100% depreciation for that animal or whatever fixed asset in the year of purchase. In 2022, that was still 100%, but with I think it was with the Tax Cuts and Job Act of 2017, this was set to start sunsetting, and so that's what we're seeing now. 2023, that was 80%. Now in 2024, that's only going to be 60%, and it's going to keep going down 40%, 20%, and then 0% in 2027. So this is a very non-taxpayer friendly item. So this is up for extension. We think that it might be extended if Congress can ever get their act together, but there's no guarantees on it. And then Section 179 is the other common vehicle for depreciation. That is basically where you can take up to $1.22 million of Section 179 depreciation in 2024. There is a limitation. You can only place in service $3 million. But the caveat here is it can only reduce income to zero. So again, if you're in a loss position, you're not going to be able to drive your loss larger through Section 179. You can only take 179 depreciation up to get your taxable income to zero. Asset useful lives. These are for tax purposes, right? So for cattle, dairy and breeding are 5-year. Farm buildings and structures, if it's a multi-purpose building, it's 20-year property. If it's single purpose, it's 10-year. Machinery and equipment, if it's new, it's 5-year. Used, it's 7. Fences should not be under here. This should be its own category. Fences are 7-year property. Horses, if they are 12 years or younger, they're 7-year. If they are 3 years more than 12 years old, they are 3-year property. And then water wells are 15. And so I put the publication 225 right here. Table 7.1 and 22 and publication 225 is a great table that's got all the depreciable lives from a tax basis. But again, we talked a little bit about this earlier. It may make, from a tax perspective, we don't have any other choice but to call that asset a 5-year asset if it's a breeding animal, right? It's a 5-year asset for tax purposes. Now we can choose to write it off 60% of it in 2024 through bonus depreciation, or 100% through 179, but it's still a 5-year animal. For book purposes, if you keep cattle in your breeding herd for less than 5 years, you would want to depreciate it on your books for less than 3 years, or less than 5 years. You'd want to do it 3 years. If you keep your cattle in your breeding herd for longer than 5 years, you'd want to, again, use it for 7 years potentially. Same way with your machinery and equipment, horses, anything like that. So again, your financial statements are your financial statements. They should be helping you reflect the most accurate portrayal of your business's operating income and how you're doing. From a tax perspective, we have a different answer. So this is a common area where we have book tax differences. Excess business losses. This was another non-taxpayer friendly item that came into play a few years ago. I think 2022 was the first year it really reared its ugly head. But basically, and for 2024, we can only take $610,000 of business losses. So if you have a Schedule F and you bought maybe you bought a new piece of machinery and equipment, new tractor, and that tractor was $400,000, and you put in some more fences or whatever you did. And if it's driving a loss more than $610,000, you can only utilize 610,000 of losses in your current year tax return for 2024. Everything in addition to that 610 is converted to a net operating loss, and that'll be first carried back unless you make an election to not carry it back, and then it's carried forward as a net operating loss. But please keep in mind, this does not offset SE tax. Self-employment tax is not offset by this. So this is just another way that you have to plan around your tax planning strategy. Has to take into account excess business losses. And it's not per business. Like if you have a Schedule F, and you also have maybe you also have a Schedule C, maybe your I don't know, you have a feed store or something else in addition to your farming activity, and that's also in a loss position. It's 610,000 of aggregated business losses. So all business losses are totaled together. You can only deduct up to 578 for 2023 or 610 for 2024. NOLs for years ending after 2020. Again, you carry it back for 2 years for farm losses and then carry forward for after that. The carryback used to be available for any business or any individual, but now the 2-year carryback is only for farmers and ranchers. A few more things before we kind of switch over to some Q&A type stuff, but the section 451, this is a 1-year deferral. So all animals, inventory and breeding, if you have an excess that are sold, so that you look at the 3-year average versus your usual business practice, that can defer that income. The election is the due date of the return. I think it is subject to extension. So if you extended your 2023 return, I think it's to the extended deadline. But the successive elections are ignored when you're determining the excess number that were sold. So again, it's a 1-year deferral if you've basically sold more animals than you normally would. But again, you have to look at the 3-year average. And so this can be a tax planning strategy if your income was way up in 2023 because of any number of things. It could be drought, it could be any issue basically, but it has to look at the 3-year average, and that'll be a 1-year deferral. So that tax on that excess, the amount that you're able to defer to 2024, would all be taxable in 2024. Section 1033. So this is where you have a replacement period 2 years after the gain. So if you are in a federally declared disaster area, you have 4 years to do this. But basically, it could be sales because of disease, that's governed under Section 1033D, or sales because of weather, so drought. Anything could be flooding. We saw flooding issues several years back that this same provision could be used for. But weather-related issues, it's Section 1033E. The only difference in the two is D includes inventory and breeding animals, but for Section 1033E, it's breeding animals only. And it's only the animals that were sold in excess of normal operations. And so, but I've got kind of a tip here, kind of a planning strategy. For raised breeding stock, it could be better to report at capital gain rates, basically, and apply bonus depreciation or replacement or 179 to the replacement animals. So again, just because there is a code section out there that allows you to defer some of this income, it still might not always be the right answer, the best answer for your operation. So just use it as a strategy, but it may not be the right thing to do. So just a reminder for Section 1031. So probably everyone is well versed in this area right now, but we can only use 1031 exchanges on real property. At one time, these could be used for like vehicles or tractors or equipment, things like that. But equipment and vehicle exchanges are not deferred any longer. So you take 100% taxable. It's 100% taxable for the asset that's given up. So if you trade in a tractor, the trade-in value less your tax basis is going to be gain, subject to depreciation recapture. But then the full purchase price of the new asset would be depreciable. Back when we had 100% bonus depreciation, this wasn't an issue at all, because So what if you had to take 100% taxable income on the asset that you gave up? You got to write off 100% of the asset that you replaced it with, right? So it washed out. But with bonus depreciation sunsetting, now you have up to a 40% differential here in 2024 if you're not able to use 179. So another area where it's, again, can cause some taxable income when before there would not have been. But if you can use section 179, maybe it's a moot point. But again, that can only be utilized to take income to zero. It can't drive a loss. Some other items to consider that I think are commonly missed items. There's a fuel tax credit available for using on the road gas or diesel for farming operations. So if you're using dyed diesel, farm diesel, there's no fuel tax credit because you're already getting the credit because it was built into the price that you paid for that diesel. But if you are using gasoline in any of your equipment or undyed diesel on your farming or ranching operation, there is a fuel tax credit available. So it is based on the gallons of gasoline or the gallons of diesel. So you have to track that some sort of way. So again, it's another thing you got to track, but at the same time, it's free money because a tax credit, it is always better than a tax deduction because it is a dollar for dollar reduction of tax versus a deduction is basically it's going to be applied to your tax rate. There is a research and developmental tax credit available. If you think that you're doing anything R&D related, there might be a tax credit available for you. And there's more things that qualify than you might think. But but right now the R&D credit used to be just a boon for clients because everyone loved it. But currently we have IRC 174, and this is a current provision that we thought Congress was going to get their act together and repeal this back in February. They keep punting and punting and punting, and we still haven't gotten any positive movement on this. But basically, what IRC 174 is where you have to take research and experimental costs and capitalize those to your balance sheet, and then you then you're forced to amortize those over 5 years instead of deducting them currently. And so that you might be subject to Section 174 whether you take an R&D credit or not. So just something I wanted to just make mention of. And, if you have questions on this, things might apply to you. I'm happy to talk more in depth after this presentation. Mileage deduction, hopefully you guys are all utilizing this, especially if you have a Schedule F on your 1040. You can take mileage or actual on your vehicles, not both. So just know that. There's still a Section 199A deduction. So if you have income, there's a 199A deduction if it's qualified, which is a 20% deduction. So basically, if you have $100,000 of Schedule F income and you're taking a 199A deduction, you're only paying tax on 80,000 of that income. Business interest expense limitation, not going to spend much time at all on this, but it is another area of the tax code that's basically causes you to potentially capitalize business interest expense instead of being able to deduct it. And installment sales, that's always a good thing to utilize if you have big gain items. If you're selling real estate or anything like that, consider the utilization of an installment sale to help spread your taxable income over a few years. And just real quick, we're gonna cover a couple more slides and we'll switch over to Q&A, running a little bit behind, but we'll send all these slides out to you guys. But what is the goal here? It's to have a tax planning strategy. So the tried and true plan of accelerating deductions, deferring income, while that's tax planning 101, just understand this may not be the best alternative for you, especially if you're thinking about succession planning and things like that. It might not be the right answer. Tax planning is not done after year end. Again, this is simply compliance. I had a client this year with a big gain. They didn't like the amount of tax we're showing that they had to pay, but if we would have been involved in the front end, we potentially could have structured the transaction differently to provide a different tax answer. But since it's already closed and the ink's dry, so to speak, there's not a whole lot that you can do. Then you're just in a compliance and reporting the gain instead of planning for the gain. Get a good advisor, someone that understands farm and ranch accounting, I think is always advisable. There's a lot of really good CPAs out there. So obviously, I'm not asking all of you to use me, but just use somebody, because I think in the ag space, I see so many times, I think there's dollars left on the table for people not understanding farm and ranch accounting and helping you guys, one, save on tax, but also run a profitable business. And again, understand the impact of minimizing tax liability has today on the future. If you're deferring income tax, again, that's a great thing, but at some point that deferral has to stop, right? You can't kick the can down the road forever. There's only a very certain fact pattern where you might truly be able to do that, but at some point that tax liability is going to come to fruition. There's gonna be a future pay date. Succession planning. There's an example in here later that talks about how if you're deferring all these taxes to later, how this can have a negative impact when you start talking about transitioning the operation to the next generation. Just one quick slide, because I'd be remiss if we didn't at least touch on this. The current gift and estate law is set to sunset in 2026. Currently, up until death, each spouse has 12.92 million. This was as of 1/1/23. It's different as of 1/1/24. It was 25.8 million, 25.84 million per a married couple. That is set to sunset and to go back down to pre TCJ laws, and I think we're expecting it to go back down. I think it's roughly 3 million per individual, but it'll be indexed for inflation, of course. But again, it's still a lot of money, but it's significantly less than what it is now. It could get extended, it could get repealed. We're still up in the air on what's going to happen. But the point is, if you are thinking about transitioning your operation to the next generation, gifting, estate planning, all those sorts of things, now's the time to do it and start looking into that. So with that, we'll just kind of get through all these rest of these slides. Oh, here's my contact information. If anybody wants to reach out after the fact, but we'll kind of spend a few minutes on some Q&A questions now. So I don't know, Brent, can you see? I'm trying to get them pulled up here.
Yeah, for sure. Do you just want me to start reading one by one?
Yeah, that's
That'd
fine.
be
That's
easiest for you.
fine. Yep.
Okay. I'll try to start with some of the shorter questions first. So first one, will you cover the Texas Franchise Taxpayer Annual Report? What is the definition and details?
Sure. Yeah, so that changed this year. There's always been a franchise tax filing requirement, but there was a no tax due filing requirement prior to 2024. So basically, if you make less than a certain amount of money, I think it's like 1.4 something million for 2023, you don't pay Texas franchise tax. Prior to this year, there was a no tax due report that was required to be filed. They removed that this year, which I think is a good thing, because it was a nothing form, but they still are requiring taxpayers that are registered with the state of Texas to file a public information report. So there's still a filing required, but there's no tax due. It's just a administrative process that you have to file that franchise report. If you do have more than 1.4 million in gross receipts, then you pay franchise tax. And the way the franchise tax works, it's a margin tax. It's not an income tax. So Texas, as we all know, doesn't have an income tax, right? I just filed my tax return yesterday because it was the last thing I did. I didn't pay anything to the state of Texas. That's one of the great things about living here. But we do have a margin tax, and basically there's 4 different ways of calculating margin. You either do revenue less. I think it was revenue less 1.1 million. I don't remember the current amount, or revenue less cost of goods sold, revenue less compensation, or there's an easy computation method. But basically, you figure out your margin and then you pay tax on that margin, and there's a rate that's applied to that.
Okay, so next question, does the safe harbor rule 3 to 5 year profit apply on cash or tax basis? In other non-account words, do you count asset depreciation for the profit definition?
Yes. So basically, the hobby loss rules it's a tax provision, right? So depends on how your tax return is prepared. And so the Schedule F most times is a cash basis filing. You can file your Schedule F on an accrual basis, but typically that's the larger operations that are required to be filing an accrual basis tax return for farming and ranching. So because nine times out of 10, if you can be on a cash basis, it makes sense to be on a cash basis. So yes, it would be on the cash basis or tax basis financials. And what was the last part of the question?
Oh, can we pull it back up? Do you count asset depreciation for the profit definition?
Yes, yeah, so that is taken into account when because basically what they're gonna look at is your Schedule F taxable income, right? But again, that's one of those things where we that's a point of argument for us is like, well, yes, that it showed a loss, but if we add back depreciation, it was this, right? But again, we're getting a tax deduction for those depreciation dollars, so that's why they still use that for purpose of the calculation.
I communicate from my home to my farm in my personal vehicle. Is there a way to write this mileage off on my personal taxes as unreimbursed expenses? Farm is set up as an LLC.
Good question. So unfortunately, no. So commuting miles are not considered business miles. And so the rationale behind that is just like for me, I live about 20 minutes from the office. And so when I'm driving into the office, those are commuting miles. And so for me to get to the office doesn't allow for any deduction. And it would be the same for you as well. So if the farm is your place of business, basically where you live, the distance between your place of business and where you live is always going to be considered commuting miles. So those are not going to be allowable for the mileage deduction.
Next question. I am an up and coming rancher starting from the ground up, still working on my education. When is it advisable to get a CPA for my future operation?
Good question. So I think that's one of the great things about the SRA and like the present programs like this. I don't think it's ever too early to find someone to start talking to, right? Like there's a lot of good CPAs out there that would just be more than willing to just kind of be a kind ear to hear you out and to help you answer your questions and things like that. But I don't think it's ever too early to talk to someone. It doesn't necessarily mean that that it would make sense for you to start paying someone to file your tax return for you. But at the same time, I do think it would be a good idea to get everything set up and organized early on, because it's a lot easier to create good habits than it is to break bad habits. And to, if you set your financial statements up in the right way when you're starting, it's just going to be that much easier going forward.
So this next question is a little longer. Insurance proceeds question. Tornado last year destroyed a trailer. Insurance paid 70,000 in proceeds for damages. We decided to sell a trailer as it is for 40,000. Took that 110,000 and bought a new trailer for business. How do I enter the 70,000 insurance proceeds in journal? Cash and revenue other income or cash and owner contribution, since it was used to buy a new asset?
Got it. So I think I need to like run those numbers together, make sure I have the fact pattern correct. But basically, if you get insurance proceeds, if you get insurance proceeds for 70,000 and you spend that $70,000 on a new asset, that is what you're using that for. So that wouldn't be taxable income to you. But if you use the 70,000 for something other than to buy that new asset, then that's going to be taxable income to you. So I would say probably the best way to record that would be if you're but because basically what happens is you would, debit cash, you would credit insurance proceeds, and then when you go buy that new trailer, you would debit trailer, credit cash. But in this situation, I would debit the insurance proceeds. So basically, you're going to have a deferred, your basis in that new asset is zero. So you're not getting a deduction for it, but you're also not picking up income from the insurance it's received. And so all that would be deferred. So then when you sell that trailer in the future, your basis is zero. And so whatever you sell it for in the future would be taxable. So I know there was another number in there, 100,000. So I can look at that question after this and make sure I have all the facts correct on that one.
So next question, going back to comparing buying a brand new truck versus a 5-year-old truck. The 5-year-old truck depreciates too, and it may need a lot of expensive repairs. How do they decide between a new expensive truck with less repairs, a warranty and higher depreciation available versus the older, less expensive truck, which has more repairs, no warranty and less depreciation available? Is there a benchmark or a general rule of thumb to follow?
Yeah, good question. I think that's the age-old question that we all kind of deal with, right? I think kind of just looking at that from a, from a cost analysis, basically, is it was where usually where I start. What's a new one going to cost? But that new one is probably going to, it's not only going to cost more, insurance is probably going to be more expensive. And so then buying the old one, I think what the purchase price is, then I think you're just going to have to estimate what potential repair costs are going to be. But I think it just kind of depends on what you're comfortable with in kind of a risk perspective of those repair costs having to come out of pocket to cover those versus the true known cost of buying that brand new asset. And again, if it's used for business purposes, do you have the ability to buy the new truck, or should you go with the 5-year-old model?
Okay, so at this time, if you have any last minute questions, feel free to submit them in the chat box or Q&A box. We'll give everyone a few more seconds to ask any last minute questions.
Perfect.
And just a reminder for everyone, if you did not get your question answered, to email education@tscra.org, and we will send those over to Brant so we can get those questions answered for you. And if you'd like the slides at the conclusion of this webinar, please email us as well, and we will get those to you. Thanks for joining us today, and we will be in touch with next month's Ranching 101 webinar. Thanks for joining
Awesome.
us.
Thank you, guys.